Hey gang, it's Jeff and welcome to our Tuesday live stream. As always, we are delighted to have you here, especially later in the evening, 7 p.m. New York time. That's a little later for a lot of people post dinner. Joining me today, we have our producer Jill. She's going to be going through the questions in her usual expert manner. Before we get going, just a couple of housekeeping items. First, the standard disclaimer on the channel. We need this for the state of New York. Many of the questions we cover here are nuanced. We'll do our best to answer them, but responses are meant to be directional, not exact. Your situation may require more details than we can get in a live stream. So this live stream is for educational purposes only. And we haven't had the opportunity to speak with you one-on-one, so please treat this information as general guidance, not advice to act upon. For anything specific to your situation, make sure that you talk with a qualified professional. All right, now before we get going, two things. One, a lot of you have received R.A. Parker's book digitally. You sent an email to livestream@holyschmidt.com. There were several of you that requested the book in the body of the live stream in the comment section. We don't know how to send it to you there because we don't have an email address there. And it's not a good idea to put your email address in the comments section of anything. So if you are looking for Ari's book and you haven't received it yet because you put a comment in the comment section, send an email to livestream@holyschmidt.com and we will get that digital copy to you within 24 to 48 hours. Now, before we jump into it, I want to cover off something non-Social Security related. Today's live stream is about Social Security, but we've had a few questions about this document right here. And this came out yesterday. It's the advice notice of methodological changes for calendar year 2027 for Medicare Advantage, capitation rates, and Part C and Part D payment policies. So this is a big document. It's been all over the news, and the original reporting of it has gone from a government decree that Medicare Advantage companies can't raise rates on policyholders. And when you read this document, that's not what it says. It says that the government is capping the amount that it's going to be paying the insurance companies to an increase of 0.9%. And the long and the short of the 168-page document is that they can't reconcile the amount that is being paid out to Medicare Advantage. It seems like overutilization compared to traditional Medicare. And so as a consequence, this is a way to try to balance that. That's 168 pages in 30 seconds. There's a lot more to it than that, but basically it's in what's called review phase. It'll be out there for a month or so for comments, and then final determination will be on April 6th. All right, now that I've gotten that out of the way, Jill, why don't we jump into the questions? My favorite part of the live stream.
All right, great. Hello to Ruth. Hello, Track Guy. Hello, Tony from Reno, Nevada. Thank you for being here with us tonight. So we have a lot of questions that have come in. Aloha from Hawaii. Welcome.
Aloha.
So we have a lot of questions that were emailed in, and as always, we will take your questions live. So please do put those into the chat box. Also, if you are here live with us and you sent a question in before the cutoff for tonight's live stream, which was 4 p.m. Eastern time, let us know in the chat that you are here live, and we'll try to go right to your question as quickly as we can. All right, so please put your questions into the chat box, and we will get started. We have a question from Brett, Jeff, that will start the night off. He says, I'm taking Social Security at age 70. When should I begin the application process so that my benefits start as soon as possible after my 70th birthday? Are there any issues or special considerations to be aware of as a U.S. citizen receiving Social Security while living abroad?
So there are no issues with a U.S. citizen living abroad, with the exception of maybe half a dozen countries. If you were living in Cuba, you would have a problem because there'd be no way to wire the funds to you there, and the same thing for North Korea. But outside of places like that, no, there's no problem with you living abroad and receiving Social Security. If you are not a U.S. citizen, if you are a resident, but you're not a U.S. citizen and you're eligible for Social Security, there are requirements for you to come back to the United States. I believe it's every 6 months or so, just to make sure that you keep your Social Security active. But for U.S. citizens, there's no requirement like that. Now, Brett, one of the things that for Social Security, one of the aspects that is really important is that you're trading off benefits. You're either taking your benefit earlier and your payment's smaller, but you get more of them, or you're taking it later and your payment is bigger, but you don't have the benefit of the same number of payments. Once you hit age 70, you don't have any upside to waiting. There's none. Nothing happens for you past age 70. And so it's important that if you're going to file, and the wording of your question made me worry about this a little bit. It's important if you're going to file that you file before your 70th birthday, not around your 70th birthday, because you could lose a couple of months of payments. So I would say the answer to your question is file 4 months. You can file up to 4 months before your 70th birthday. Most people do it 3 months, but you can go as far back or as early as 4 months before your birthday.
All right, great. Christy mentioned she sent in a question earlier this morning. Christy, I don't see the question here on my list, so please do type it into the chat box. Also, just a reminder, tonight questions will be answered about Social Security. We will resume Medicare in the next week. Is that correct, Jeff?
That's right. So we'll come back to the Medicare questions next week. We'll have Ari back on again. I could answer them, but I think it's better to come straight from the source. And so when Ari is back on, we'll have the Medicare questions as a focal point.
All right, great. So our next question comes live from Jackson Clan. A quick message, please. If a husband and wife retire on the same day in July, do they each get to earn $5,000 each per month and not pay money back for the balance of the months past July of that year?
Sorry, is this a Social Security question?
Jackson Clan, do you want to just clarify? Is this a Social Security question? They both retire on the same day in July. Okay, we'll wait for a response.
I think it's an earnings test question, but I'm not sure. So maybe we can wait for Jackson to come back.
Okay. All right, perfect. So let's take a question from Vicky. Vicky is asking, I'm 63 and my husband retired at 68. He'll have to start required minimum distributions at 73 in 2 years. Can I take my Social Security for 2 years, then stop it until I reach full retirement age without a penalty?
No, you can't. The way that Social Security works is that you can stop your Social Security once you reach full retirement age and let it continue to grow. I think that's your question. Now, if you start to draw Social Security and for whatever reason you're going to have an issue with the earnings limit, for example, then you can request that they freeze your Social Security payment or reduce your Social Security payment so that you don't have to give part or all of your payment back. But the only time you can continue to let your Social Security payment grow is once you reach full retirement age.
Okay. And Let's see. We did get clarification that this is a Social Security question from Jackson Clan.
Okay, so Jackson, I think your question must be about your whether you can work and claim Social Security. There isn't a $5,000 just blanket benefit that you and your wife get, but if you're asking about, in fact, would you reread the question, Jill?
Yeah. If a husband and wife retire on the same day in July, do they each get to earn $5,000 each per month and not pay money back for the balance of the months past July of that year?
Yep. So the question is, it's an earnings test question, and so $5,000 a month is, you must be in your full retirement age year. So let me just give everybody the rules around the earnings test, because they're pretty specific. If you retire and you start to draw Social Security, you can earn as much as you want up until the point, the day you retire and you start drawing Social Security. It doesn't matter if it's the middle of the year, a third of the way through the year, 2/3 of the way through the year, everything up until that point. If you're earning a certain amount, the Social Security Administration isn't going to come back and say, hey, you earned too much this year, we want you to give back part of your Social Security payment, because you haven't received any of your Social Security payment yet. But once you claim Social Security, then you have what's called an earnings test. The earnings test for any year where it's not your full retirement age year. So for most of you, full retirement age year is age 67 or somewhere around there. The actual year that you turn age 67 is your full retirement age year. For any year that is not the year where you turn 67, your earnings limit is $24,480 in 2026. That is $2,040 per month. So in 2026, if you worked until mid-year and you earn more than $24,480, well, it doesn't matter. The first year only, they turn it into a monthly test, and that's how you get around the fact that you've earned more than the limit and you still don't have, you can still receive a Social Security payment. If this is your full retirement age year, that amount is $65,160 for the year, or $5,430 per month. So the $5,000 a month amount that I think you're talking about is the $5,430. As long as you earn less than $5,430 in your full retirement age year per month, you won't have to give any of it back to the SSA.
All right, great. Brad, thanks for letting us know that you emailed in a question. We're going to take Brad's question. He said, I'm 61. My spouse is 70 and does not have enough work credits to qualify for her own Social Security benefit. So she would only be eligible for a spousal benefit once I file for Social Security. I'd prefer to wait until age 70 to claim for longevity and tax reasons, but I'm considering filing at 62 so my spouse can receive spousal benefits. Is there a way for me to file at 62 just to trigger spousal benefits for my spouse, but delay receiving my own benefit until 70? If I wait and file later, can my spouse receive any retroactive spousal payments? Separately, if I do file at 62, how is my spouse's spousal benefit calculated? Is it based on 50% of my full retirement age benefit, 50% of my reduced benefit, or something else?
So, Brad, I put together a video just for you that I released yesterday, and it's called The 3 Mistakes People Make with Their Social Security Spousal Benefit, or something similar to that. It addresses all those questions, but I'm going to address them with you here as well. Unfortunately, your spouse can't file for a spousal benefit until you file, so you have to go first. The file your Social Security and then suspend it and let the spousal benefit continue to play out isn't available anymore. It used to be a feature of the Social Security Administration, but they figured out that people were gaming the system and they stopped that loophole. So if your spouse wants to claim the spousal benefit, you have to file first. The spousal benefit is not based on what you actually receive. It's based on what you would receive at full retirement age. It's up to 50% of the amount you would receive at your full retirement age. So if you're 62 and your full retirement age is age 67, if your payment was $2,000 a month at age 67 and it's $1,400 a month at age 62, even if you get $1,400 a month, the spousal benefit is going to be based on what you would have got at full retirement age, $2,000 in this case. And so your spouse's payment at full retirement age, at her full retirement age, would be 50% of that, $1,000.
Okay. We have Embwy asking, pension aside, 403B B for better, be enough. Is there an optimal time of year to begin to draw Social Security? I'm going to wait until 70.
I don't. So this is a variation of a question on, and there's an answer to the variation, and that is, when is the best time of year to retire? And so I'm going to discuss this point because, frankly, it doesn't matter whether you retire or whether you draw Social Security in February, you draw it in October. You're really, once you reach 70, you should take it immediately. You don't want to wait, because anything beyond that, you're really leaving money on the table. There's no growth to your payment anymore, and so you should take it immediately. But this question is often asked in a different way, and the other way that it's usually asked is, what's the best time of year to retire? And the question really revolves a little bit more around the other stuff that comes with retirement. For example, if you have a 401k that vests in February, you probably don't want to retire in January. You want to get the vesting for February, or your company match, more likely October, November, but you get the point. So as far as Social Security is concerned, there isn't really a good time of year, except for if you're over 70. I can't really think of a good reason why you would want to not start receiving Social Security at the point where you turn 70.
All right. Debbie is asking, I put in for Social Security to start January 2026 in November. I've sent 2 emails to them and gotten no response. They're in phase 2 of phase 3 of review. I worked 48 years at my last job and was terminated a year ago. I did have some severance pay in 2025. I was just wondering what the holdup was.
Yep. So it could be a lot of things. That the Social Security Administration is now understaffed, and their systems were always, as far back as I can remember anyway, a little antiquated. So there was a lot of manual work that was being done at the SSA. Good people dealing with very difficult equipment, effectively. It's probably one of 2 things. Either they're having some staffing issues, or more likely there's a document that they're trying to verify. So when you file for Social Security, you have to provide documents digitally, usually, to prove you are who you say you are. And oftentimes when you present a document to the SSA, if anybody ever got a hold of your Social Security number to use it for work, let's say, then they have this strange stream of income that they know when they're looking at it that it probably doesn't belong to you, but they don't know what to do with it. So it goes through a manual process. My strong recommendation here is take your mobile phone, call the SSA, put it on hold, even if you have to sit there for an afternoon until you get a hold of somebody, do some paperwork or something else, and just leave it on speakerphone until you get through and have a discussion with a real person. I wouldn't wait to find out by email what the holdup is. Stage 2 of stage 3 means that there's one stage left, and that could be 1 week, it could be 1 month, it could be 6 months. I will say that if it ends up being, and it sounds like it's already been past the time where you wanted to draw Social Security, because you filed on time, it really is their issue, not yours. And so they'll make a retroactive payment to bring you up to what you're supposed to get, or what you would have gotten up until that point in time, but that doesn't pay your bills, at least not today. So my advice would be just give them a call and talk to them. Call 1-800-772-1213 and just stay on hold until you get a hold of somebody.
All right, great. So Jay Bikaki, I hope I pronounced that correctly, is asking, is your birthday the best target date to start Social Security benefits, or is it better to take it in January?
So it's funny. You're actually doing me a really big favor here. The questions are coming through, and they allow me to really push some videos I put out in the last month or so. And one of them, I'm just pulling it up now, is called "This False Social Security Belief is Cutting Retirees' Income." And basically, the whole premise behind this video is that people overwhelmingly, like it's like 80%, some statistic like that, overwhelmingly take Social Security on their birthday. And it's their 62nd birthday, their 67th birthday if their full retirement age is 67, or their 70th birthday if their full retirement age is age 70. But you have 96 different options. You can take it at any month between the time you turn age 62 and age 70. I hope I did the math right. But and in every month that you wait, you get a little bit more on your payment. So your payment doesn't increase only once a year, it increases every single month. And so whether you take it in January or whether you take it at age 67 or 70, it really should fit into your lifestyle. So people make a lot of unusual decisions around this point. Your Social Security payment should cater to your retirement decisions. Your retirement decisions shouldn't cater to your Social Security payment. For example, if it's better for you to retire at age 62 and 9 months, don't retire at age 62, because you'll get more if you wait until 62 and 9 months, unless you have another reason to retire at age 62. And so January or your birthday or anywhere in between, you really need to look at your own individual situation and adjust when you file for Social Security based on that, knowing that every month is an increase to the size of your Social Security payment.
All right. Holly Mitchell is asking, my husband just passed away. And Holly, so sorry for your loss. I'm 67 years old and haven't started taking Social Security yet. Will I be better off taking his Social Security, which he started taking at age 62, or my Social Security?
Okay, so a couple of things here, Holly. If he started taking Social Security at age 62, you probably qualify for something called the widow's limit. Now, what the widow's limit is, and it's really a technical aspect, but write this down because it's super important. But when your partner passes, for a partner that has filed at age 62, if you wait until you're, I believe it's 63 and 9 months or older, you actually qualify for a higher benefit. So in this case, his isn't capped at 62. It's effectively capped at 63 and 9 months. And so look into the widow's limit on the first instance, because I think your payment's going to be higher than you think it is with his. Yours, on the other hand, you have a choice. You have an option to let either one grow. You can take his payment and let your own Social Security grow. And so you're 67, you actually can't go the other way. So as a spouse, your maximum Social Security payment, your widow's limit, you can't grow the spousal, or the survivor benefit more than 100% of what's due to you by waiting past age 67. You can grow your own Social Security payment all the way up until your own age 70. So you can get up to 124% by waiting till age 70 with your personal payment. So that's a long-winded way of saying you need to look at the specific situations just do the math. It's not super hard, but it is going to require for you to consider waiting. For me, it means I can let it grow to 124% on mine. Waiting for my deceased spouse means that I can get up to 63 years and 9 months of their full retirement age payment. And just do the math that way. Jill, you're on mute.
Sorry, thank you for the reminder. Okay, so Kim is asking, I'm 61 and will turn 62 in March. I was married for 24 years and divorced 10 years ago. My ex-spouse will be 67 this November and plans to wait until age 70 to claim Social Security. My understanding is that because we've been divorced for more than 2 years, I may be eligible for a divorced spousal benefit even if he hasn't filed yet. Can I start my own Social Security benefit at 62 and then later switch to a divorced spousal benefit based on his record if that benefit is higher when he turns 70?
So 2 things here. You are correct. Once you've been divorced for 2 years or longer, you're decoupled from him having to file before you qualify for the spousal benefit or the divorced spouse benefit. There is one element here that is, whether this is the divorced spouse benefit or the current spouse benefit, and you can have both, by the way, and Social Security Administration will pay both, something called deemed filing. So what deemed filing means is that if you qualify for 2 benefits, the minute you file for one, if you qualify for a spousal benefit and your own benefit at the same time, and then you file for one, you deem to have filed for both, and the SSA will give you the larger of the 2. So in this instance, you will get whichever one is larger. So that might mean that if you are looking to grow your own benefit more, maybe you want to wait more. I don't know. It really depends on your specific situation. But when you're deemed to have filed, or when you qualify for both, you're deemed to have filed for the larger one, and that's it.
Okay. Cheryl is asking, both my wife and I just turned 70 and I'll get my first check tomorrow. My wife started collecting when she turned 68. If I predecease my wife, will she be able to change to my full benefit age 70?
So your question is, it's about the survivor benefit, and your partner's already started their own benefit. Yes, this is the one instance where the SSA, and I have to say, usually the SSA rounds down, and I use that as it's not a technical term, but it's probably the best term to describe it. And that is, anytime something can break one way or the other, it almost always breaks in the favor of the SSA. And it's little things, it's not big things. But with the survivor benefit, they kind of go out of their way a bit, I would say. If you look at some of the aspects, there are some things about the survivor benefit I don't think are fair, but a lot of the rules are different when it comes to the survivor benefit. One of those rules is if there is both benefits, and we just talked about we just talked about the deemed filing rule with the previous discussion, and the SSA is just going to give you the bigger of the two. You can't manage that because that's just the rules. Well, the survivor benefit's different. You can, in fact, claim one benefit and let the other one grow. And you actually can claim either or. In your specific situation, the fact is the survivor benefit won't grow past the survivor's full retirement age. So it's already maxed out there. But their own benefit, the 68-year-old's own benefit, could grow to age 70. So one strategy here might be to claim the survivor benefit and let the other benefit grow until age 70, the primary insurance amount of the survivor, and then switch.
Okay. Jose just had a comment about that he appreciated the recent spousal benefit video and was wondering if you have a plan or he's recommending a survivor benefits with big age difference scenario.
Yeah, so that one I've been kicking around for a long time. And the recent spousal benefit video, I got a lot of polarizing reactions, which I kind of knew when I put it up. There's no clean way to explain it without getting really technical, and I tried not to, but the reactions went from, wow, we really love this, thank you for explaining this in a very sensible way, to I have no idea what you're talking about. Now, one of the problems with that video is that I used a spouse and their partner, and I used two gender neutral names. And I did that because in this day and age, you don't know who is the primary earner. So I just thought, let's just use two gender neutral names. But apparently it confused some people. The difficulty of the spousal benefit is nothing compared to the difficulty of the survivor benefit, if you want to get into that level of detail. By the way, and I'm not pitching my course, Social Security Simplified, but there is an entire module on the survivor benefit. And what it has to do is it takes it, and there's one video on the first piece. And once we've locked in the understanding of the first piece, there's another video on the second piece. And once we've locked that in, there's another video on the third piece. Eventually, after 5 or 6 pieces, you can fully understand the survivor benefit. If it's a good idea, and I have the data already written and ready to go. I just need to be able to make sure that I can present it in a way that is not too technical, because I as you can tell from this live stream, I can geek out on this stuff. I can tell you to the dollar how much you're going to be earning at 68 years and 3 months. I mean, that's because I love it. But unfortunately, the survivor benefit is very technical. So if you really want to become a master of it, shoot me an email at livestream@holyschmidt.com. I'll send you a coupon code for a discount. But yes, I have thought about it, and I'm just working through how to do it in a way that more people can understand than not.
All right, great. Love that you that you can geek yourself out on
Yeah.
it. And I believe that is true. All right, Frank is asking, right after the 2024 election, we saw news reports about a possible temporary 3-year extra tax deduction for people over age 65.
Yep.
That deduction actually law yet? If so, is it currently in effect, and who would qualify?
Yep. So it is in effect. It's $6,000 per person. So a couple qualifies for $12,000 as long as they're both age 65 or older. It's a standard deduction. It's not an itemized deduction, and the vast majority of people in retirement do file standard deductions. They don't itemize. And so if you're itemizing, that's a problem. But it's a standard deduction, and if you pop your data into TurboTax and you're doing your taxes this year, it should just recognize it right away. And if you have a tax preparer do it, well, they'll pick it up. And if you're doing it by hand, there's probably a section in there that says if you're 65 plus, you qualify for this deduction. But it's a standard deduction, $6,000 for you, $6,000 for your partner. if they're 65 or older, and it's automatic.
Okay. Let's see. Ruth is asking, I want to retire at 65 and use my pension lump sum to delay Social Security until 67. Is that a good idea?
People take Social Security for a lot of different reasons. The one thing you don't have to worry about is if you get a lump sum payment from your employer or a pension payment from your employer, even if it's not a lump sum payment, that doesn't violate the earnings test. So there's no earnings limit issue. So you can get, if your employer gave you $1 million a year, you wouldn't have to give any of your Social Security payment back if it was a pension. If it was earned income from self-employment or from working for the employer, then you would have an earnings limit issue. So it really becomes a philosophical one at this point. And by the way, there is a tax implication to this, and that is, if you want to, there are taxes on Social Security, and up to 85% of your Social Security payment can be taxable. That doesn't mean that you pay 85% tax on your Social Security payment. It means that depending on how much you earn, it can become a taxable line item on your tax return. You can still not pay taxes on it if you have enough deductions, but it really is a question of whether it can even go on there in the first place. So then it becomes a philosophical question. Putting the tax issue aside, people file for Social Security for basically 4 reasons, and who am I to judge? Some people file early because, you know what, they've worked all of their lives and they're not trying to maximize every dollar in the payment, maximizing the size of their payment. They worked all of their lives, and at age 62, they're done. They're going on vacation or going on a cruise for a year, and then they're going to go on some wild vacation, maybe fly to Africa, I don't know. But they're going to really live it up, because the go-go years in retirement are the early years, of course. And that type of person would also not be as worried about having the finances to do something like that. So they're not trying to extract every dollar. Then there are the mathematical types. And these are the types that say, you know what, I'm going to get out my calculator and I'm going to figure out how I can get every last dollar from the SSA. And I'm going to do it in a way where that is going to determine how I run my life. I might even make a retirement decision based on that information. It's called break even. Used to be a big feature of the SSA website. Not so much anymore. In fact, I don't even think there's a break even table on there anymore, because there are a lot of reasons you take Social Security besides getting the maximum dollar amount. Then there's someone who wants to protect a loved one, a survivor. And the fact is, we've talked a lot about survivor benefits. The longer the primary insured waits, the larger the survivor benefit becomes, up until age 70. So the primary insured can wait until age 70, and the survivor uses the age 70 payment as the basis for his or her own survivor benefit. And then the last one is people who just need the money, and life's been hard. They've tried, they've done everything they could, and it just broke the wrong way. And so they file early. And as I said, who am I to judge? Of the arguments out there, that's the least powerful argument, but it also is a very real situation for a lot of people. So it's an entirely personal decision. Unfortunately, I wish I could give you better guidance than that, but I can help you frame the thinking, and maybe that's a good start.
All right, Joe is asking, I'm 60 and my wife is 55. When we retire, our combined income will likely exceed the 44,000 threshold for married couples, meaning up to 85% of our Social Security benefits would be taxable. Given that, would it be more prudent to delay claiming Social Security and instead rely on withdrawals from my 600,000 401k and a small pension of about $1,200 per month until my wife is closer to retirement age?
Yep. So it depends. And And I hate to give an "it depends" answer, because this goes back to the disclaimer at the very beginning of the video. Because we've never talked, because I don't know you personally, I don't know what your lifestyle looks like, what your aspirations are, physical limitations or medical issues. But there is a video that I put out 4 videos ago called "Should You Claim Social Security Early and Invest?" And this is one that has, I suspect, it's changed a lot of minds of people on filing early and using the funds to invest. And in your situation, whether you're retiring early and investing, or you're retiring early and living off of your investments, if you're not working, that is the lever to make the decision on what's the best way to maximize your options. If you're making a decision on whether you're going to continue to work for a few years or not, and the decision breaks to I'm gonna retire early so that I don't have to pay taxes on this, or I don't have to give any of that back to the SSA, well, it sort of defeats the purpose. So check out my video, "Should You Claim Social Security Early and Invest?" I think that'll answer your question, if the question is around economics.
All right. So Kirtleby has a question, I think, that relates to that video that you were just mentioning. And he prefaced it by saying this might be outside the scope of tonight. So we'll just check in and you'll let us know. I was listening to the downsizing video earlier. Is there any relation to age or Social Security relative to avoiding or reducing capital gains taxes?
Yeah, there used to be a and there's a lot of confusion. This, by the way, if you haven't checked this video out, it's called "Here's Why Downsizing After Retirement Doesn't Make Sense." And it's not an absolute statement, but it is one that you really need to pay attention to. Everybody thinks that when they go into retirement, they're going to downsize. And if you do it right, it works. But in the video, we talk about basically the methodology of downsizing. And I use New York downsizing and moving to Florida as an example, because I'm in New York, and most people in New York, or a lot of people in New York, when they make the move, they go down to Florida, either the Miami area or the Sarasota area. And I broke down all the costs associated with selling your house and then buying a smaller house. And a lot of the arbitrage making the New York to Florida move, in that example anyway, didn't work. Now, that doesn't mean it won't work, but Florida used to be a really inexpensive place to live. I'm just using some data from 15 years ago. It was 87% of the national average. Now it's a flat 1.0. New York, I think, is 127%. The biggest state is Honolulu at 177% of the national average. But I digress. So age, you make decisions to downsize. Traditionally, people have done it for economics. But when you actually look at the crew that actually does it, because only 17% of the people out there actually downsize. They don't make the moves. The other 83%, they kind of stick around. And why do they do that if it's so advantageous? Well, because of family, or because they've done the math and they realize that selling my house and paying, out up to 5% of the value of the house, maybe more, I don't know, in terms of closing costs and taxes and other expenses makes it a lot less attractive. They've done the math and it just doesn't work for them. But the question about age, and what was the other element, Jill?
Social Security.
And Social Security. So Social Security doesn't change whether you retire in New York or you retire in Florida. You're going to get the same Social Security payment. It's a good question. And actually, if the cost of living adjustment were regionalized, that's one thing I think would be a really good thing. But you could game that so easily that you couldn't enforce it. You couldn't monitor it. But the age bit is another reason to downsize. Going from New York to Florida might on the margin make sense, but financially, but if you don't want to go through horrible winters, and I don't know about you, anybody who's in the New York area right now, I've got 3 feet of snow in my driveway, and they just finally got us out the other day, like yesterday. So there's a lot of good reasons to leave New York for if you're as you're getting older, and there are a lot of reasons to downsize for health reasons. I mean, besides the weather, a one story home, so you don't have to go up and down stairs. Stairs are really dangerous as you get older. That's just the way that it goes, unfortunately. So I think that do the math, understand that it might not be the lottery. You're not winning the lottery, but it still might be the right decision for you. And that's really the basis of the video. And if a lot of people didn't get to the end of the video, they decided they got frustrated at the math, and they probably realized it was right, and a couple of people left a comment. But at the end of the video, I do say there are times where it works, but you really have to have a big arbitrage. If you're going from Honolulu, Hawaii, which is 1.77%, 170% of the national average, to I don't know, let's pick Georgia, Savannah, Georgia, which is a wonderful place, by the way, and you decide that that's the move I'm going to make, you could probably make it work pretty easily. But New York to Florida, not so much.
All right. Jules wants to know about survivor benefits, and so he wants to know how he can access your course, and is he eligible for a discount code as well?
Yep. So Jules, send a note to livestream@holyschmidt.com and just put a coupon code in the title. I give everybody who comes in through the live stream a discount. So just put coupon code for course or something similar, and we'll have that out to you in the morning.
All right. Thank you for that. And Sunji is asking, I will be 62 in June. My spouse will be 62 18 months later. Can I claim my small Social Security, then get a larger spousal benefit? Or should I wait and both of us claim together?
So you'll be 62 in June, and your spouse will be 62 in December of 2027. And so the question is, should you claim now and collect your benefit and switch to a survivor benefit? Was that the question, Jill?
Spousal benefit. Switch to the spousal benefit.
Switch to the spousal benefit. Sorry, the spousal benefit. Big difference, actually. So going back to the deemed filing rule that I talked about before, when you file for one or the other, if both are available to you, the SSA is just going to give you the larger of the two. If one is not available to you, it's because your partner hasn't filed for their own benefit, and the one that wouldn't be available is the spousal benefit. So if your partner hasn't filed for their own benefit, when they file for their own benefit, then the spousal benefit becomes available to you. So there is no deemed filing for both benefits if you don't qualify for the spousal benefit. But there is a mathematical issue, and that is let's just say that you have you personally have $1,000 personal benefit, and your partner has a $3,000 benefit. So the spousal benefit's $1,500. If you file early at age 62, and you would have qualified for the spousal benefit had your partner filed, it would have been a much smaller number. It would have been 32.5% of 3,000. And I'm doing this in my head here, so it's roughly $975. So the difference is $275, $700, which is the early payment of your $1,000. You get 70% of your own benefit, or you get 32.5% of the spousal benefit. That $275 that you don't get because the spousal benefit hasn't been available to you yet is the only thing that you still have left to grow. So you file for this case, you file for your own benefit, it's 1,000, but because you're filing at age 62, you get 70%, you get 700. The only thing that continues to grow is the difference between the two. And you don't even need to know anything about the numbers I just gave you. Just know that once you file for one, that locks in a portion of the larger benefit at the lower rate. And so if you want to know more about it, check out my video, 3 critical spousal benefit rules many people miss. It was out a few days ago.
Okay. I have Christy, I believe I see your long question. Good question. It's an IRMAA related question. So I think, are we going to take that one and we'll be addressing that next week? Or Jeff, do you want to take that now?
Well, we aren't really doing Medicare questions right now. Why don't you just give it to me since we already have it out there, and I'll answer it.
Okay, so let me bring it up to where it starts. All right, so after a layoff in late 2023, followed by 18 months of unemployment, I finally accepted a new position earning $35K less than I had been earning and moved from San Francisco to Long Island to renew my career.
Mhm.
To supplement my income, I opted to initiate my full Social Security benefits at age 66 and just received my first payment. Did I make a mistake tax-wise, or will my IRMAA be reduced since my income dropped to nearly zero in 2025?
Well, it depends on what your income is, I suppose. I mean, IRMAA it does have brackets, and if you exceed the brackets, there are instances where there are 8 instances, in fact, where you can appeal the IRMAA surcharge. So I would say most people, if your income is going down and you're talking about historical income, your IRMAA is going to be in a better place than had you maintained your income or maintained your job. So I think just from the perspective of the IRMAA surcharge, you're less likely to have one if you didn't have income in 2024 for 2026, for example. It's always 2 years back. So they measure the income from 2 years ago for the payment, the IRMAA expense today. And the reason they do that, by the way, it's not like your tax return. They don't actually review the numbers and challenge you on the numbers. I suppose hopefully you don't get challenged too much by the IRS, but there's a process in place, and by the time you get past the 2-year mark, back 2 years, then that number has been vetted. That's why they wait 2 years. But if there's a sizable decrease in your Social Security payment or a sizable decrease in your income, then it's less likely that you're going to have an IRMAA surcharge.
Okay, Christy, I hope that I asked Jeff the question in the way that you wanted it asked. You were bringing it in pieces, and there's so many things that came in between.
Christy, email the question to me at livestream@holyschmidt.com, and I'll give you a more considered response. And just if you can give me some numbers, you don't want to do it on a live stream, but you can give me some numbers, I can come back to you with a better answer.
Okay. Yeah, so I think that I got most of it, but yes, if Christy, if there's anything left unanswered, that sounds great, Jeff. Thank you for that. Okay. Chris Herman is asking, does the earning limit only apply to income from a job, or does income from 401k, IRA, taxable investment stuff also apply?
Only from a job, either working for somebody else or working for yourself. Your investments, unless you're a professional investor as a career, which I've only, well, in New York, we see quite a few of them. They're called hedge fund managers. But unless you are a professional investor, then that's not your job. And the vast majority of people are not receiving income from their 401k as a job. So you'll have other issues. You'll have tax issues that you need to deal with, and Social Security tax issues. because 401k and IRA distributions do raise your potential anyway to have your Social Security payment taxed, but simply from drawing down from your retirement account, no.
Okay, we are at 5 minutes to the hour, so we're going to try to get through as many more questions as we can. Mike is asking, if I start Social Security at set amount and then a year later I go back to work and start paying back into Social Security, will my benefit go up monthly, quarterly, yearly, never?
So the question is, if you are taking Social Security now and then you go back to work and they freeze your payment, will your Social Security payment increase again?
Yeah.
Yes, but it's done manually. Now, remember at the beginning of the live stream where I said that there are a lot of really good people at the SSA, but they're dealing with antiquated systems. So in theory, if you, it's not even theory, this is the fact. If you either have to return part of your payment to the SSA or they freeze your payment and then you continue to contribute to your Social Security, that the amount that you returned back to them or the amount that you didn't receive gets added to your base, and it enjoys the same benefits as if you hadn't taken those funds out. And then at full retirement age, your full retirement age benefit will be larger. Once you reach full retirement age, you can earn as much as you want, and your payment will not be withheld or reduced.
Okay. Quiet one is asking, I'm 68, will take Social Security until 70. Wife, 67, will be full retirement age this June. Married for 29 years. Divorced from 2008 until 2023. Remarried while wife was already over 62. Can she receive half my full retirement age at hers this June? Is that
Okay, so let me rephrase the question because I think I know what you're asking. You have a partner that you married in 2023, and you want to know if your partner can get half of your Social Security payment because they were married to somebody else. Yes, the rules around receiving the spousal benefit, the spousal benefit, not necessarily half, but in this instance, yes, half. The rules around the spousal benefit are that you need to be married for at least 1 year. And the exception to that is if you are the parent of the primary earner's child, natural parent, meaning biological, or in most cases, the adopted parent. Because you've been married since 2023, you passed the 1 year mark, and now your partner qualifies for your spousal benefit.
all right? A question from Jeff. My wife and I both still work full time. My wife filed for Social Security at her full retirement age last month. I plan to file this June when I turn 70, so I can receive the maximum delayed retirement credits. If I were to pass away before I file in June, how would my wife's survivor benefit be calculated?
Yep. So the SSA, the survivor benefit, I keep saying this, the SSA rounds up on this. They really give people the benefit of the doubt. And if you had not reached full retirement age, they would have assumed you passed away at full retirement age. If you're over full retirement age, then they use the date of passing. So if you are going to be 70 in June and you happen to pass away, knock on wood, in April, well, that is 68 years and 10 months, and that would be the date that they would use for when you would have filed for your Social Security payment, and that would be the basis for your partner's Social Security payment.
All right. Roy is asking, for a married couple filing jointly, if one spouse starts receiving Social Security, do the other spouse's wages affect how Social Security benefits are taxed? How are we taxed as a couple? And if I begin collecting Social Security, how much can I earn from work, including income from a hobby, before my benefits are reduced? And how does that earnings penalty work?
Okay, so that's a lot. Let's start off with the tax element. Taxes on Social Security are calculated at the family unit level, assuming you're married filing jointly. And so you will have thresholds. And my guess is that if you have a 2-income family and you're asking the question, you're probably going to exceed the thresholds. So you will probably have your Social Security will have at least a portion of it eligible for taxation. That doesn't mean that you're going to pay taxes on it, but just like interest income or any other type of income, whether you actually pay taxes on that amount or not depends on deductions and how you arrange your life financially. So there's a good chance that amount could in fact be taxable, or at least qualify for a line item in your adjusted gross income. Doesn't mean that after all of your deductions you're going to be paying taxes on it, but it does mean that a portion of it could be on that line item. In terms of working while collecting Social Security, your partner and you are completely separated. You don't, if your partner is working and you are not and you're collecting Social Security, that doesn't reduce the size of your payment. You don't have to give any of your Social Security payment back if your partner is working, and vice versa. And I think that was everything. Was that all of the elements of that question?
There were a lot of them, but I believe you touched upon all of them. Yeah. Okay. So we are at 8:02. So we are past the top of the hour. Out of respect for everyone, we do want to keep to the time. JS had an IRMAA question. JS, I think we'll hold that for next Tuesday when Ari Parker is back and he can really address that. Is that correct, Jeff? Is that a good idea?
Yeah, that's a good one. And speaking of Ari, gang, for those of you, I just want to mention this one more time. Ari is one of the co-founders of our partner chapter. Chapter is our trusted Medicare partner, and their phone number is on the lower left-hand corner, 440-703-1224. If you have any questions, give them a call. But Ari comes on quite regularly, and he's a pleasure to work with. He there isn't a question I don't think he could answer around Medicare, but around Ari, and Ari's offered to give a digital copy of his book to folks. For those of you that want one, don't put a request in the chat because we're not going to know who to send it to, and definitely don't put your email in the chat because there are bots out there that gather that information. But if you want a copy of Ari's book, just email livestream@holyschmidt.com and we will send you a digital copy within a day or two, completely free. Ari's gift to you.
And what's the name of his book?
It's called It's Not That Complicated. It's a great book. It'll take you an hour or two to read. It'll give you a really strong foundation on Medicare, and it's something that I've read it personally maybe half a dozen times, and it's one of the better books out there. It's for Medicare. It's one of the best books on Medicare out there.
All right, great. Well, thank you so much, everyone, for all your questions, emailed as well as live. Please come back next week and join us and bring those questions again. I'm going to turn it back over to you, Jeff, to close us out.
Gang, we are 4 minutes over. Sorry about that. We try to be prompt, but sometimes we also try to balance the fact that we want to get to people's questions. We will see you next Tuesday at 7 p.m. New York time. And thank you for staying up with us and using your evening to be with us on the live stream rather than something else. We very much appreciate it. And Jill, thank you so much for doing a wonderful job, as always, as the producer of the show. And we will see everybody next Tuesday at 7 p.m. Take care, everybody.
Bye.